Yesterday afternoon, an Iranian cruise missile hit a tanker in the Strait of Hormuz and killed a sailor. And by the closing bell, the Nasdaq had put up its best day in a week. Good morning. It's Wednesday, July 15th. I'm Nick Vertucci with Eleanor Whitfield and Marcus Brooks. No fourth chair today. Just the three of us working through a session that honestly shouldn't have closed green, and somehow did. We've got the Fed, a blockade that's now drawn blood, bank earnings that split the group right down the middle, IBM's worst day maybe ever, and a chip stock that rebounded 28% less than 24 hours after cratering 15. Plus what's actually on deck today, and there's a lot. Eleanor, Marcus, business first.
2 wins, 3 losses now, streak of -2. That one hurt.
3 and 4, streak of +2. That one didn't.
Let's do it properly instead of just reading the record. Eleanor, you had a conditional call. If core CPI came in north of 0.3% month over month, the 10-year breaks 4.65 and holds. What actually happened?
Core CPI didn't come in north of 0.3. It came in at 0. Flat. Below the 0.2 the street wanted, and headline fell 0.3 below consensus too. My own trigger never fired.
So the call was never live?
Technically, no. But I'm not going to hide behind that because my actual thesis, yields push higher regardless of what CPI says, because oil overrides the backward-looking number, that part I can grade, and it's wrong. The 10-year fell to 4.583. Didn't come close to 4.65. I'll take the loss.
Appreciate you not lawyering your own conditional. That's twice this month you've done that.
It's not a habit I enjoy building.
Marcus, yours was cleaner. SK Hynix's Nasdaq. Shares closed back above 160.
And it closed at 193.92, up 28% on the day. I said if it can rally through scary oil and geopolitical headlines, that tells you the flush was flow, not fundamentals. It didn't just rally, it erased the entire Monday crash and then some.
We'll come back to that one, because I don't think you've actually won the argument yet, even though you won the call. Sarah's not with us today, but you left a checkable marker too. Brent closes back under $80.
It closed at 84.73. Not particularly close.
And this morning it's essentially unchanged from there. So, rough morning for Sarah, wherever she is.
We'll log it as a loss in her column when she's back in the chair. All right, let's build the actual show. Eleanor, start with the number that was supposed to be simple yesterday and wasn't.
June CPI. Headline rose 3.5% year over year, down from 4.2 in May, well under the 3.8 the street expected, the sharpest monthly drop in headline inflation since April of 2020, per the BLS release. Core, the number that strips out food and energy, was flat month over month. 0. Below the 0.2 consensus wanted, and core year over year fell to 2.6 from 2.9.
That's not a cool number. That's a genuinely soft number.
It is, and on any normal Tuesday, that's an unambiguous rally in bonds and stocks both, full stop.
But yesterday wasn't a normal Tuesday.
Right? Because it landed in the same 90-minute window as 5 bank earnings reports and about 6 hours before a naval blockade took effect in the Persian Gulf. So instead of a clean rally, you got the VIX spiking 14% intraday towards 17 on the Iran headlines, even as the actual inflation data said the Fed's job might be further along than anyone thought.
And then it round-tripped. VIX closed down 4.25% at 1643, practically unchanged from Monday once the dust settled.
Walk me through why that round trip matters more than the headline close.
Because it tells you which force actually won. The S&P finished up 0.4%, Nasdaq led at 0.9%, the Dow barely moved because IBM was single-handedly capping it. We'll get there, but under the hood, the disinflation story won the day over the geopolitical scare. Yields falling to 4.583 instead of spiking is the real tell. The bond market believed the CPI print more than it believed the missiles.
Which is the opposite of what half the desks were positioned for at the open. Fed funds futures had hike odds at 46% Tuesday morning, up from 34% on Sunday, purely on the oil shock. That completely reversed once the number actually printed.
It should reverse. That's the system working. My discomfort, And this is where I'll defend the thesis, even though the call itself didn't fire, is that June's data was collected before this week's oil spike even happened. August's CPI is the one that actually captures a Brent print in the mid-80s. We're relieved by a number that's already stale.
So translate that for somebody who just hears CPI good, stocks up, and moves on.
Simply, the government measures last month's prices, not this month's. Oil jumped 9% last week. None of that shows up in the report we got yesterday. It shows up next month.
Which is a fair caveat, but it's also the same caveat every single month, and the market still trades the print it has, not the print it's afraid of. I just say, don't let one good caveat turn into ignoring a genuinely strong number.
Noted. So today, Warsh is back in front of Congress, Senate banking this time, after House Financial Services yesterday. Does a soft CPI print make his job easier or harder?
Easier on the inflation side, harder on the does the blockade change everything side. He has to explain why a supply shock in the Gulf doesn't automatically become the Fed's problem in front of a committee where roughly half the members already want another hike.
My money's still on him being boring on purpose. It worked yesterday. Nobody's talking about what Warsh actually said. They're talking about IBM and tankers. That's a win for a new Fed chair.
All right, let's go to the tanker part, because it's not really a market story anymore. Somebody died. Eleanor, what actually happened overnight into yesterday, and where does it stand this morning?
The mechanism changed from what we were watching all week. Iran's Revolutionary Guard said it struck two, quote, non-compliant supertankers in the Strait. Separately, the UAE's defense ministry said two of its own tankers were hit by Iranian cruise missiles transiting Omani waters inside the strait, and one crew member is confirmed dead. That's per Al Jazeera and CNN's live coverage from yesterday.
That's the thing our fourth chair yesterday said would cross her line. An actual hit on a loaded vessel, not just posturing. It happened the same day she was drawing the line.
So the marker got crossed almost as soon as it was set.
Almost exactly. And then, on top of the strikes, the naval blockade itself went into effect right on schedule. 4 p.m. Eastern 2000 GMT per CNN's live desk, covering Iranian ports and coastal waters, plus that 20% toll on any cargo transiting without U.S. authorization.
Here's the wrinkle, Bo, and it's the part that actually matters for oil pricing going forward. Bloomberg reported 6 U.S. sanctioned supertankers, 12 million barrels combined, slipped through the strait with their transponders switched off in just the past week, after Washington revoked Iran's temporary oil sale waiver on July 7th. So even with strikes, a blockade, and now a fatality, oil is still finding a way through the choke point. Quietly, but it's moving.
Which is exactly why Brent closed at 84.73 instead of triple digits. If the blockade were actually watertight, you'd expect a much bigger number. The market's pricing real disruption, not full closure.
Devil's advocate for both of you. Is there a version where this whole thing is closer to done than it looks? A fatality strikes a blockade that sounds like it should be de-escalating from here, not escalating.
Sure, that's a real possibility. Exhaustion is a real dynamic in a conflict like this. 4 flare-ups in 3 weeks eventually just runs out of road. But a dead sailor raises the floor on how quietly either side can back down without looking weak. That's usually when these things get worse before they get better, not the other way around.
I'd agree with that read. This morning, WTI sitting around 79.70, Brent near 85.31, both a touch higher overnight per CNBC, on another round of U.S. strikes. Nothing here says de-escalation yet.
So oil, watch it. We'll come back to it at the setup. Let's do banks, because 5 of the country's biggest reported the same morning and somehow produced 5 completely different stock reactions. Marcus, take me through it.
It's the cleanest lesson in earnings season you'll get all year. Every single one of the 5 beat consensus. Goldman, JP Morgan, Bank of America, Wells Fargo, Citigroup, and the stock split violently anyway. Goldman posted the best quarter in the firm's 157-year history, $20.98 a share, a 45% beat, net revenue up 39% to $20,030,040, investment banking fees up 55%, shares up 7.4%.
What drove that specifically?
SpaceX. The June IPO raised $86 billion at a $1.77 trillion valuation, the largest listing ever. and it supercharged underwriting fees across the whole street. Goldman's equity underwriting revenue alone more than doubled. JP Morgan rode the same wave, $6.14 a share against $5.85 expected, revenue of $58 billion against $50 expected, shares up about 2%.
And yet Citigroup and Wells Fargo fell.
Both beat comfortably. Citi posted $30.15 a share against roughly $2.74 expected, a 15% beat on its best revenue quarter in a decade, $24.8 billion, and announced a $30 billion buyback on top of it. Stock fell 5% anyway.
Because management said they pull forward job cuts and tech spending, meaning costs show up before the efficiency does. Wells Fargo beat $2 a share against $1.72 expected, 25% EPS growth, and still fell 3.33% on CEO Charlie Scharf's cautious tone.
So the beat itself wasn't a story.
Not even close. The market's pricing the next 2 quarters, not the one that just happened, and that's why a 15% beat can still get sold. Jamie Dimon actually gave us the other half of this on JP Morgan's call. He disclosed AI has already let the bank cut headcount by up to 40% in some units.
That's the bull case for the whole sector. Honestly, real structural efficiency, still early innings.
Except Dimon himself tempered it on the same call. He told analysts not to expect AI to meaningfully lower the bank's cost base anytime soon, because every competitor's adopting the same tools and competing away any single firm's edge.
Which, fine, that's Dimon being Dimon, hedging his own good news. I still think the efficiency story is underpriced across the group.
Give me a level, not a vibe. What would prove you right?
Morgan Stanley's print later this week. If it shows the same SpaceX and Alphabet underwriting windfall without the cost caveat Citi and Wells attached, that's confirmation the theme's broader than one bank's quarter.
And Bank of America, the one we haven't mentioned, where does that fit?
Almost boring by comparison, which given the day is a compliment. A more modest beat, shares up about 1.3%, no windfall, no caveat, just a clean quarter that the market shrugged at because it wasn't dramatic in either direction.
Which tells you something too. The stock reactions today weren't really about beat or miss. They were about which story a bank told on the call. Boring stories got boring reactions.
Financials are one of the heaviest weighted sectors in the index, so this isn't just a bank story.
Right. It's a genuine swing factor for the S&P as a whole, and it's not contained to the 5 money center names either. Regional lenders are getting read the same way now. Equity band shares put up a clean quarter overnight, net income up sharply, efficiency ratio improving, and management credited it to a merger finally paying off. Small, but it's the same beat plus discipline story playing out one size class down.
Hold that thought. We've got 3 more stories and I want time for all of them. Let's take 30 seconds because I need it after that segment. I filled up on the way in again this morning.
How bad?
Bad enough that I did the math out loud in the car like an idiot. 9% oil moves are fun on a chart and considerably less fun at the pump.
The economy, everyone. Very abstract until it's your gas tank. We said that yesterday too.
We did, and it's still true today, so I'm allowed to repeat it. Back to the tape. IBM. Eleanor. This is the one that actually capped the Dow yesterday.
IBM fell 25.21% to close at 217.07, the steepest single-day decline in the company's history, worse than 1987, per CNBC. Preliminary second quarter revenue of $17.2 billion against roughly $17.9 expected, adjusted EPS $2.93 against $3.02 expected. Infrastructure and mainframe revenue down 7%.
What's actually behind it? Because this isn't a normal earnings miss.
It's the AI boom actively hurting a tech bellwether instead of lifting it, which is rare. CEO Arvind Krishna said the company faltered, his word, because enterprise customers redirected budget toward memory chips and servers that have gotten scarce and expensive as AI data centers vacuum up global DRAM and HBM supply. Software and consulting contracts, the stuff that makes up IBM's margin, got deprioritized so clients could lock in hardware before the next price hike.
Where does the stock actually sit now, technically?
It briefly traded below its 50-day moving average, around 261, and it's deep inside a 52-week range that runs from about 212 up to 332. Trailing price to earnings near 24, Dividend yield now above 2.4% after the drop. So there's a valuation argument forming already for anyone who thinks this is overdone.
Which is exactly the bull case some longtime holders are making. A business with a large recurring revenue base, no direct AI loser thesis attached to the actual core franchise, now trading at a yield and a multiple that looks almost cheap if you squint.
The bear case is just as simple, though a CEO saying the company faltered is a visibility problem, not a timing problem. If the memory shortage runs into 2027 the way suppliers are suggesting, this exact quarter could just repeat itself.
Citi's analyst put it about as bluntly as you'll ever see a banknote phrased. This perpetuates AI loser fears. HSBC downgraded to reduce with a $191 target and said, and I'm quoting, they prefer synthetic IBM to the real one.
That's a genuinely brutal line for a research note.
It is. Though not everyone capitulated. BofA cut its target to 280 from 330, but kept a buy, and Evercore reiterated outperform at 310. So the streets split on whether this is one bad quarter or the start of something structural.
The read-through is what worries me more than IBM itself. ServiceNow fell about 7% in sympathy, Salesforce 5, Accenture 8, Cognizant 7, the whole enterprise software and consulting complex got dragged down on the logic that if IBM's customers are cutting software budgets to afford memory chips, everyone's customers might be doing the same thing.
Steelman, that for me, Marcus. Even though you're generally the one who likes the AI capex story, make Eleanor's case as strongly as you can.
Fine. The honest version is, this is exactly the kind of demand diversion signal you'd expect to show up first at the most commoditized, least differentiated software vendor in the group, and IBM fits that description. If a name with actual differentiation, say a ServiceNow, reports its own quarter and shows the same pattern, that's not an IBM story anymore. That's a sector story, and the market's right to have gotten ahead of it yesterday.
Thank you. That's more concession than I expected.
Don't get used to it. I still think IBM's specific mix old mainframe cycle winding down, big deals that are genuinely just timing, makes it a worse comp for the group than the market's treating it as. But I'll own that the read-through isn't crazy.
What actually resolves this?
ServiceNow and Salesforce's own numbers whenever they report. Until then, the market's treating the fear, not the fact.
All right. Now the story that's the flip side of everything we just said, because somebody's clearly benefiting from that same memory shortage. Marcus, SK, Hynix.
This is a wild 4-day chart, debuted Thursday at 149, popped 13%, raised $26.5 billion amassanates, biggest U.S. listing ever by a non-U.S. company. Monday, the Seoul shares fell 15.4%, worst day in nearly 2 decades for the stock, dragging the Kospi down with it. Then yesterday, 28% higher, closing at 193.92 on the Nasdaq ADR.
What actually flipped it that hard, that fast?
3 things stacked on top of each other. Barclays initiated coverage with an overweight and a 330 target. South Korea's government announced a national AI budget. And this is the part that actually matters for how real this move is. Granite Shares and ProShares launched 2 times leveraged single stock ETFs on the ADR per 24/7 Wall Street, and that mechanically pulled buying volume into the name and lifted Micron 5% in sympathy.
That last part is exactly my problem with calling this a clean win for the demand thesis. A 28% one-day move, 4 days after a 13% IPO pop, and a 15% crash, with brand new leveraged ETFs launching into it. That has the fingerprints of flow and mechanical rebalancing all over it, not investors calmly recalculating the value of an HBM franchise in 24 hours.
I said the same thing yesterday morning before I made the call, and I still won it. The stock closed at 193.92. That's not a blip, that's erasing the entire Monday crash and adding on top of it.
Winning the number doesn't settle the argument though, and you know that. A leveraged ETF launch creates real buying pressure regardless of whether the underlying thesis is right. That's sort of the whole point of them. They amplify whatever direction the flow's already going. I can believe the move is real and durable and still think yesterday's size was inflated by mechanics that have nothing to do with HBM4 shipment timing.
Then here's my actual test. On the record, it holds. If SK Hynix gives back a big chunk of yesterday's move over the next few sessions once the leveraged ETF rebalancing flow dies down, that's your case. Flow, not fundamentals, just delayed instead of avoided. If it holds these levels or keeps climbing, that's a real repricing that happened to get help from ETF mechanics on day one.
I can live with that test. And for the listener, the plain version is, watch whether this was a burst of borrowed buying or an actual floor. We're not calling it today.
So that's officially unresolved, and I'm leaving it there instead of picking a side. That's the split to watch. Let's get to today because it's loaded again. Eleanor, what's actually on the calendar?
2 data points before the bell, June CPI at 8:30, and the Empire State Manufacturing Index same time. Then Fed Chair Warsh is back at 10, this time in front of the Senate Banking Committee, a day after House Financial Services.
And the big one for our world, ASML reports before the European Open and ahead of the US bell. Consensus is roughly $7.94 a share on revenue near $10.3 billion per multiple previews. The number that actually matters is whether they raise full-year guidance for a third straight time. They've already moved the range up once, to 36 to 40 billion euros from 34 to 39. Options are pricing an 8% single-day swing.
Why does a third raise matter more than the second one did?
Because it stops being one good quarter and starts being the whole industry keeps under-forecasting AI capex quarter after quarter. That's the checkpoint air test system set up after the bell last night. Honestly, smaller burn-in and test equipment maker guided fiscal 27 revenue to 130 to 132 million, nearly tripled this year, and the stock popped 26 to 30% in after hours on it. Same story, one rung further down the supply chain.
Which is the tension I keep coming back to. The same AI capex wave that's lifting air and might lift ASML today is the exact thing that gutted IBM yesterday. It's not one story, it's 2 sides of the same reallocation, and today we get to watch both play out at once.
Anything else on the tape today?
Conagra reports fiscal fourth quarter and full year results this morning, a read on pricing power in packaged food. Progressive publishes June numbers too, auto insurance underwriting margins, after a strong May. Neither moves the index, but both are worth a glance if you're in those names.
And what's stacked behind today once we get through it?
Taiwan Semiconductor reports tomorrow, alongside monthly retail sales. That's the next real checkpoint on whether the chip side of this trade is actually as strong as ASML's about to suggest today. Retail sales also tells us whether the consumer's still spending through a 9% oil move.
So today's not a one-off loaded morning, it's the start of a stretch. Which fine, this whole month has been that.
And oil obviously stays the variable everyone's watching into the calendar too.
OV W2 is around 79.70 this morning, Brent near 85.30, both slightly higher overnight on more US strikes. Nothing's de-escalated since last night.
All right. Closing calls. One specific, checkable thing each for today's close. Eleanor.
ServiceNow, Salesforce, and Accenture all close red again today, extending yesterday's IBM sympathy sell-off. Once the market decides a name is next in line for the same CAFEX diversion, it doesn't wait around for that company's own earnings to price it in. It sells first and asks questions on the actual report.
Marcus, and I already know part of this one.
SK Hynix closes higher again today, above $200. Not just holding yesterday's move, extending it. If that happens 2 days running, the leveraged ETF explanation gets a lot harder to lean on, and Eleanor owes the demand thesis a little more credit.
I'll pay it if I'm wrong. I generally do.
2 calls, 1 clock, both resolved by tonight's close. So here's today PPI and Empire State at 8:30. ASML's number sometime before our own open, Warsh in front of the Senate at 10, and oil still sitting in the mid-80s with a blockade that's already drawn blood. Watch whether software keeps bleeding in sympathy with IBM. Watch whether SK Hynix holds 190. And watch Brent for any actual sign this is cooling instead of just pausing. If the show's useful heading into a day with this much stacked on it, catch our daily charts and reels on Instagram at NovaVentures_US. That's your Nova Ventures morning brief. Have a great Wednesday, and we'll see you tomorrow.